All right, it is time to get this party started. This webinar is being recorded, and the link to the recording on Northwest YouTube channel will be shared with everyone once it is ready. Hello and welcome to our webinar, IRA Cafe, a beginner's guide to individual retirement accounts. This webinar is part of Northwest's Financial Wellness Series. My name is Denise Kitchen, and I'm one of the relationship managers of the Retail Sales and Service Department. Our department manages the partnerships the credit union has with organizations so that they can offer credit union membership as part of their benefits package to their employees, members, and volunteers. First off, thank you so much for your interest in our webinar today. And secondly, I would like to go over some housekeeping items. Everyone is muted, and we ask that you hold your questions until the end of the presentation and then ask them via the chat feature when we get to our Q&A session. You can find the chat feature on the very bottom right of your screen. It has a little bubble next to it. If you don't want to post your questions here, email addresses will also be displayed at the end. You can use your reactions button, however, at any point during the presentation to let us know how we're doing. There's a little smiley face on the bottom of your screen that you can click on and let us know how we're doing throughout. Also, we will be raffling off a $25 Visa gift card after our Q&A session at the end. So please make sure you stay tuned until the very end. Now, without further ado, I'd like to introduce our esteemed panelists, Joanna Wilbur, our IRA Trust and Estate Accounts Manager, and Chris Greenhill, our Private Relationship Manager. And Chris is going to get us started today. So Chris, please go ahead and take it away.
Thank you so much, Denise, and good afternoon, everyone. You know, as Denise stated, I'm the private relationship manager here at Northwest, and I want to first thank you for your time today, and set the expectations about what we'll be talking about today and on the IRA Cafe. Hopefully, you'll walk away with a lot more knowledge about IRAs, and be more equipped to be able to save for retirement as well. So you probably heard people say that they're looking forward to retirement, some even counting down the days. I've heard retirement referred to as the ultimate vacation. And as you probably know, if you want to have a great vacation, you're going to need to plan for the trip. So today we'll talk about two different retirement options, traditional and Roth IRAs. There are certainly more retirement vehicles, but today's focus will be a beginner's guide to IRAs. So in the spirit of our lunchtime together today, let's learn about the two most common tools to build your retirement. We will show you the differences and similarities of the two IRAs and help you determine which is best for you. So let's get started. So we know real sandwich eaters know that bread is truly what makes a sandwich great. So an IRA, which will be our bread, is our foundation for savings. And we'll talk about the benefits that it brings. When you reach retirement, you want to feel secure about, where you are, and you certainly don't want to outlive your savings. Financial security for most people means simply being able to pay your bills, buy those little things that make you happy, and hopefully having some left over after that. Most of us won't be fortunate enough to win the lottery. So the rest of us is just going to have to work and save, because once you get to retirement, you generally only have your retirement accounts to draw from, like your IRAs or your employer savings plan or investments. Those things will truly shoulder the load in terms of giving you the income you need for retirement. There's a quote that I heard from a comedian that was asked about his retirement, and he said, I have enough money to last me the rest of my life unless I have to buy something. And the IRAs that we'll talk about today will be great tools for you to save for retirement so that you can buy or pay for something. Just like starting to build a sandwich, is good to start with great bread. So what is an IRA? An IRA, or individual retirement account, is a tax advantage way for you to save for retirement. So one might ask, Chris, I have a savings account. Why should I consider an IRA then? I can just save for retirement with my savings account. Um, while your money is being saved in an IRA, you're not paying taxes on its growth until it's withdrawn. This allows you to grow your money faster than paying taxes on the growth every year. So, and this, you can really see this in action. You can just check out an online calculator and you can just plug in those numbers, and you can really see the difference in tax deferred growth versus paying taxes every year on those funds. Now, the magic number that I want you to keep in mind is 59 and a half. 59 and a half. I'm going to say it one more time. 59 and a half. This is the magical number that you need to get those tax benefits out of your retirement account. This might, this might be great. It will be great versus saving in a regular savings account. But an IRA, as I stated, is going to give you that opportunity to contribute to an IRA and still be able to grow your money more effectively. So I want to talk a little bit about how you can add to your retirement account. So you can add up to $7,000 a year. And this is up from 6,500 last year to an IRA. But wait, there's more. If you're over 50, you can contribute up to $8,000. That's up from 7,500. But you can't just stick any amount into these accounts. There are limits to how much you can contribute each year. So now that we've talked about the bread of our sandwich IRA, let's dig a little deeper. The two most common types of IRAs are traditional and Roth IRAs. So for even the most seasoned chef, most have had the classic PB&J. So we're going to call our traditional IRA our PB&J for today. We established that an IRA represents the foundational bread of our sandwich, but I want to give you a quick history lesson on IRAs. So a traditional IRA is an individual retirement arrangement established in the United States by the Employee Retirement and Income Security Act of 1974. So what happened is Congress identified a greater need for people to save for retirement and created the traditional IRA. Traditional IRAs were created to encourage savings and to reward people for doing so. So who would this PB&J be best suited for? So there are income limits or rules for the folks who make too much money for a Roth IRA, which you'll hear about later, to still be able to save for retirement. Also, you have to have earned income. This is money that this money that you earn for doing work, things that you may get a paycheck for, right? It used to be an age maximum that you can contribute to an IRA, but that's gone away. Now you can continue to contribute as long as you have earned income, and that changed as of 2020. And if you're not working and your spouse is working, you can still do a contribution to an IRA and vice versa. So I wanted to touch on one other point. Statistically, people are changing jobs 10 to 15 times over the course of their careers. And many of those jobs offer 401k plans or 403b plans or any other type of plans offered through employers. And it's best to max out your benefits there before contributing to an IRA. So don't leave free money on the table when your company is offering you matching funds. Okay, so that's 100% return, right? For you to put in money into your retirement account at your job, and they agree to match what your contributions are. But once you reach that threshold, then you can look at the IRAs as options as well. So what happens when you leave a job? Those 10 or 15 times. You really have a few options to choose from. You can take the money out and pay taxes and penalties on the funds for doing so. Please don't do that. You can leave the money where it is. But like I said, if you have 10 or 15 accounts floating around out there, that might be a little difficult to manage. Or you can move the money into an IRA. And by doing so, this isn't a taxable event, and this will allow you to continue to save your money in a tax advantage way. So when you're putting your PB&J together, you need to know what your ingredients are. And now everybody here should know what the ingredients of a PB&J is. So let's look at what that is. So I'm going to call our peanut butter our tax deferred growth potential. This is great because while your money is growing, you're not being taxed. This period of time between when you add funds and how long those funds are in the account play a significant role on how quickly that you can reach your retirement savings target. By not paying taxes along the way, as stated, your money grows even faster. And our jelly is our tax deductible contributions. So when you add money to your traditional IRA in a lump sum or based on your income, or you do it on a systematically, maybe you have a certain amount going in once a month or something along those lines. You may also qualify to reduce the amount of taxes that you would otherwise pay now. So instead of paying taxes now, you pay the taxes later. For many people, this is beneficial because they may be in a lower income tax bracket in retirement than they were when they're working. That can be reflected in how much money that they're drawing out of their retirement account, or maybe they relocated to a different state that has different tax laws in place as well. So on the previous slide, I spoke about contributions to your traditional IRA and how it may be tax deductible. So this chart will show you really show you who can join this club, the traditional IRA club, and the benefits that they get. So the chart shows you that based on your income and how you file your taxes, if you qualify to fully deduct your contribution or partially, or maybe you can't do any deductions based on your income. So if you're single and your income is less than 75,000 a year, you get the full deduction of your contributions. Okay, so you'll see that number rise to 123,000 combined income for married filing jointly. Okay, so you can see the differences there in what those limits are based on what your income is and how you file. So while tax deferred growth and deductions are great ingredients to save for retirement, even PB&Js aren't free. You still have to go to the store. You still got to buy that peanut butter and jelly. You still got to buy that bread, right? So even these things aren't free. And we know that the government is not going to let you get something for nothing. There needs to be some kind of catches to the program. So why do we have these limits? Why do we have these rules? Because our tax code tries, and I emphasize tries, to give those who they determine would benefit the most from these type of benefits. We all know that everything isn't for everyone. People with wealth will ideally always have enough money to pay those taxes still, and have money in retirement. Folks with lower incomes are the ones who will need these types of benefits to save for retirement or make it easier for them to do so. So we spent some time, talking about adding money to the traditional IRA and what happens while it's there. But what about when you need to take this money out? Some of us out here may not need an IRA or need to draw from your IRA for a longer period than others. But the government drew the line in the sand at age 73. At age 73, they said, okay, that's long enough. It's time to start taking your money out. We want our cut now. These required withdrawals are called RMDs, required minimum distributions. Okay. Also, remember when you contributed funds to your traditional IRA, you potentially received a tax deduction, right? Well, now when you take that money out to pay, you take that money out, you pay taxes at your current tax rate. But what if you need to take the money out before 59 and a half? Well, if you do, um, then you're going to have to pay a 10% tax penalty and taxes on the amount that you withdraw. But there are a few exceptions to get around that penalty, that 10% penalty. So here's a list of the exceptions to avoid the 10% penalty. Notice that I only mentioned the penalty here because you can take money out without paying a 10% penalty, but you still have to pay the taxes. You will always have to pay the taxes. So let's look at some of these options, right? So if you're buying your first home or paying certain medical expenses, qualifying college costs, death or disability, these reasons could help you avoid the 10% penalty. So we always advise speaking with a tax professional to ensure if you're taking money out of your IRA, you should be informed how much you will have to pay in taxes and if you qualify for one of these exceptions. So now that we've spent time building our classic PB&J and talking about our traditional IRA, it's time to kick things up a notch with Roth IRAs. And I have the distinct privilege of passing the baton on to my expert IRA estate and trust manager, Joanna. Joanna, you can take it from here.
Thank you very much. And Chris is going to be doing the driving of the slides for me while I'm talking. So today I'm going to tell you a little bit about Roth IRAs. Roth IRAs came about in 1997. They were sponsored by the senator from the state of Delaware, Mr. Daniel Roth. And so they named that after him. So what Chris talked about regarding the foundational sandwich, the sandwich that everybody loves, everybody has, PB&J. Well, this is a little sexier. This is the sub, right? This is a sub with fixings. This is the hoagie roll. This is because what we have here, the Roth IRA has some components to it that the traditional IRA does not, because one of the things they really wanted with the Roth IRA was that they looked at the fact that people still, even though they had a traditional IRA, they still were not saving for retirement. And what was one of the things that they said? Why aren't you putting money away for retirement? Well, one, if I need it, I can't get it. And there are some features with the Roth that aren't necessarily the same with the traditional that allow you some leeway as far as taking funds out of a retirement account. The other thing is that the funds that come out of a Roth IRA are also tax-free. So Chris, let's go to the next slide. So the Roth IRA, when you start to take that money out, this is great for people who would love to have the income that comes out of a retirement account come out tax-free. Remember what Chris told you about regarding the traditional IRA? When that money comes out, you have to pay taxes on it. You may be able to take a tax deduction when you put the money in, but when that money comes out, you always have to pay taxes. The other thing is that the Roth IRA is great if you earn less than $146,000 if you're single, or if you're married filing jointly, $230,000. It's also good that the fact is you cannot, however, you cannot take a tax deduction for a traditional IRA. There are some people that they make a certain dollar figure and they can't take a tax deduction for that traditional IRA. They might be covered by a pension plan at their job, and so they can't take that tax deduction. So then they can put that money into the Roth IRA instead and still contribute to that employer's retirement plan. And then when they go to take that money out, it can come out tax-free. Next slide, please. So, like I was telling you, the tax advantage, tax-free growth potential. This has no end date, right? This has no end date. Also, there aren't any required minimum distributions. Money that gets put into a Roth IRA, because you do not take a tax deduction for it, the earnings grow tax-free. The other thing about the Roth IRA is this: contributions may be taken out at any time for any reason, regardless of age. So that is a big difference by the traditional IRA. Remember, traditional IRA, you go to take that money out, you're under age 59 and a half, it doesn't matter, earnings or contributions. You pay taxes and you'll also get a penalty. With a Roth IRA, the money comes out, if it's contributions, and let's say you're 40 years old, no taxes. Now, you do, however, if you're under age 59 and a half and the Roth IRA has not been open for at least 5 years, you do have to pay taxes on the income that you have made. But that still is not that's still not a hard road to hoe, in that, think about it like this. Let's say you contribute to a Roth IRA over a 3-year period, $2,000 a year, $2,000, $2,000, $2,000. So after 3 years, you now have $6,000 in a Roth IRA. If you contribute $2,000 in a traditional IRA, $2,000, $2,000, $2,000, you have $6,000. And let's say over those 3 years, okay, let's say over those 3 years, you earn $200, okay? You earn $200. Okay, great. So in my Roth IRA, I earn $200. In my traditional IRA, I earn $200. If I am 40 years old and I take out $2,000, I pay taxes. Doesn't matter. I pay taxes, and I also pay the penalty. If I go to my Roth IRA and I take out $2,000, I don't pay any taxes. I don't pay any penalty. Also, I can go back to the well and take out another $2,000. Once again, no taxes, no penalty. In the traditional IRA, taxes and penalty. When I go again to the well, I take out $2,000 from that Roth IRA, no taxes, no penalty. Once again, I go to my traditional IRA, I take out $2,000, taxes and penalty, okay? Now, what's left in that IRA? $200, okay? In that traditional IRA, $200. In that Roth IRA, $200. When I go to take that money out of that $200 out of that Roth IRA, those are the earnings. So if I'm still under age 59 and a half, the only thing I pay taxes on and penalty would be $200. Only $200. So 10% of $200, $20. Great. Whatever my tax rate is, $200, great. So my tax burden is a lot less. Now I go back to that traditional IRA, I take the money out, and once again, that's going to be taxed and penalized, but my taxable liability was still considerably more in my traditional IRA versus what my taxable liability was in the Roth IRA. Let's go to the next slide. So given the fact that the Roth has these great, tax advantages, everyone and their mother should be in on this, right? Well, the Roth has income limits. First of all, of course, you have to be working, you have to have earned income, you need to get either 1099 miscellaneous, or you have to have a W-2, you have to have partnership income, something. You have to have earned income, or be married to somebody who does. Like I was telling you, once again, there's no age restrictions. As long as you have a job, you can be 5 years old. I have a girlfriend of mine, her child is a cute little child model. He's A4 adorable. So he gets a little bit of money, $5,000 here, or, $1,000 there. So she puts that money into a Roth IRA for him. The income limits are as follows. Single, $146,000 to $161,000. Married, $230,000 to $240,000. Now, the in between that limit, so if you make up to $146,000, you can make that full contribution, either $7,000 or $8,000. But once you're in that in between time, you lose some of your ability to make that full contributions. So essentially, for every $1,000 you go over that limit in that in between time, you lose about $200 worth of the ability to contribute to that Roth IRA. So next slide, please. So what do we have with the Roth again? No mandatory distributions. Remember, in the traditional IRA, you must start beginning those requirement and distributions, or RMDs, at age 73. Roth IRA does not have that. You can continue to make contributions into that Roth IRA as long as you qualify under income limits and still have some sort of earned income. You can still make contributions, and that money comes out tax-free. The money comes out tax-free once you hit age 59 and a half, and that Roth IRA has been open for at least 5 years. The 10% early withdrawal is only on earnings if you're under age 59 and a half. Next slide, please. So here are some exceptions. Just like the traditional IRA, we have exceptions to the early withdrawal penalty. First-time home purchase, certain medical expenses, and the medical expenses have to be pretty high, have to be at least 10% of your gross income, qualifying higher education costs, death or disability, okay? So there's no penalty that comes out on those earnings. Remember, penalty-free, but not tax-free, okay? Next slide, please. So which IRA is best? Now, it depends on what it is you're trying to do. Remember, Chris also talked about the fact that you can still contribute and you should definitely contribute to your employer's plan. Now, when you separate from service, do you have money in your employer's plan? If you do, you want to put that money probably into your traditional IRA. What are the benefits of that? Traditional IRA. Do you need a tax deduction? Okay. Is your income over the limit to contribute to a Roth? IRAs have no income limit. They have an income limit for deductibility, but they do not have an income limit for making that contribution. As long as you have earned income, you can make the contribution. Are you transferring your 401k plan or other retirement plan from an old job? If you do have that, like I said, you want to do the traditional IRA. For the Roth, is your income within the IRS limits? Do you want to have tax-free income in retirement? Do you want access to your contributions at any time for any reason without paying any income tax? Do you participate in your employer's retirement plan? Now, something that you should know, that if you have an employer plan and you separate from service, or you turn age 59 and a half, and you want to move that money out of that employer's plan, you can do so. You can put it into a Roth. However, if you do a transfer from an employer's plan into a Roth IRA, that is a taxable event in the year that you make that direct transfer. If you do a direct transfer into a traditional IRA, there are no taxes. So there's no tax consequences for doing that. And let's face it, maybe you've been at a company for 5, 10, 15 years, and so now you have perhaps an account at your employer that might be $20, $30, $50, or $100,000. Transferring that money into a traditional IRA is a tax neutral thing that will happen to you. Transferring that money into a Roth IRA, which is allowed, however, that is a taxable event. So paying taxes on $50, $60, or $100,000, that's a lot of money that can come out of your pocket in that one taxable year. So let's go on to the next slide, please. So how do you get started? Here at the credit union, you can open up an IRA here with a zero balance. We also don't have any fees. You can put any dollar figure that you want into that IRA, as long as it is according to IRS, contribution limits, but we don't have any minimums. So sometimes, if you have your IRA at a trust company or a mutual fund or something like that, they might have minimums that you have to put in. You have to put in $50 a month or something like that. Here, that's not the case. You can put in $50, you can put in $1 and never put in money again. That IRA is open, it is yours. So no minimums. You can also set up direct deposit so that that money can go directly into your savings account and then come right from, do a pre-authorized transfer from there into your IRA. You can also contribute whenever you like. A lot of people like to do that prior contribution at the end of the year. They want to put money in there. They have their bonuses. They really know now what they can contribute. Or they can contribute, at the beginning of the year, in the middle, monthly, however they want to, ad hoc, it doesn't matter. So we don't prescribe how you put your money into your IRA. We just say, please do. Definitely save for your retirement. Do what you can. You don't have to always put in the minimum, rather the maximum, just putting away some. Some is always better than none. So the next slide, please. And here we are. Any questions? We're here for you. I'm Joanna Wilbur. The other person is Christopher Greenhill, and Denise is our lovely hostess.
Awesome. Thank you so much, Joanna and Chris. This was amazing. As always, very, very good and useful information. So now it is time for the fun part. Not that this whole thing hasn't been fun, but this is even more fun. All right. So now you get to answer your or ask your questions. So I did write one down that was asked earlier in the chat. And again, just as a reminder, you can ask your questions in the chat feature, which is on the very bottom right, has a little bubble next to it. So go ahead and type in your questions there, and I will ask you guys the first question that I received, which was, can you please talk about backdoor Roth IRA 2023 and 2024 and the process to contribute at Northwest Federal Credit Union?
Sure, I can do that for you. So backdoor Roth, what that is essentially, that's a conversion. All right. So the IRS allows you to put money into a traditional IRA. And then if you want to, you can convert that money into a Roth IRA. And the reason it's called a backdoor Roth, remember we told you that there are income limits. So if you make too much money, you cannot contribute to a Roth IRA. But remember, there's no limit as far as income goes for your traditional IRA. So what that means is that you can make a contribution into a traditional IRA. And if you wanted to, then you could turn around and put those funds into a Roth IRA. That is a taxable event. So when you move that money out of that Roth IRA, out of that traditional IRA, put it into the Roth, you pay taxes on that dollar figure. You do, if you're under age 59 and a half, however, you do not have to pay the additional penalty. Okay. And the way that is set up here at this institution is what you would do is you would open up a traditional IRA, have that here. You would open up the Roth IRA, have that here. You would make your contributions into the traditional IRA. Then you would sign the IRA withdrawal form. You would ask to do a withdrawal of X number of dollars. Don't withhold any taxes. Don't have to pay any penalty. And the box that is checked is, if you're under age 59 and a half, is early withdrawal with exception. Check that on the box. The withdrawal is done. Then those funds are put into the Roth IRA, and the code that is used is Roth conversion. Okay, so that is how that is done at this institution. Other institutions have other ways to do it, but that's how that works. And what you will end up getting will be a 1099-R from us if the IRA was here at our institution, showing that withdrawal coming out with the proper code. And then you would get a 5498 in May 31, it comes after May 31st, showing that conversion contribution. Those two together, the IRS has that, and that way you don't have to pay any penalties if applicable, and two, you pay the taxes on what you take out.
Thank you so much, Joanna, for that. Second question, if you do not qualify for a Roth IRA due to income limits, but you do have an option within the 401k to contribute, is there a maximum amount you're allowed to designate for the Roth within the 401k?
Take it away, Chris.
No, you got it. It's on the raw.
No, there really isn't. So it's the amount that you can put into that employer plan. Okay, so it's not $8,000. It's what the employer says that you can put in. So you're putting in a percentage. So if you're putting in 10%, 8%, that's the way that works.
Awesome, thank you. Next question is, how much does NWFCU charge to maintain a Roth IRA account? Can I invest my Roth IRA funds in stocks, or does NWFCU do that for us?
So we are a credit union, Northwest Federal Credit Union. We are a credit union. By law, we cannot invest in stocks, bonds, and mutual funds. Northwest Federal Credit Union does not charge in any way for its products. Okay, so we don't charge for IRAs. We don't charge for anything like that. Chris is in private banking, and we also have the CUSO, the Northwest Financial Group, and Chris will speak more to that.
Yes, so as Joanna was speaking about the differences here, we have Northwest Federal Credit Union and we have Northwest Financial Advisors. You can have IRA products in either one of those channels, right? So as Joanna stated, on Northwest Financial Credit Union, we do not charge for those services. But when you invest with Northwest Financial Advisors, the fees that you pay will be based on what investment you're participating in with them. But the IRA itself doesn't cost you anything. But if your question is based on the mutual fund or other types of investments, those are going to be driven by the type of investment that you have to determine what the cost would be.
Thank you so much. Hang on, we just got another question. What if your income fluctuates? If you might exceed 140,000 one year, but not another, how do you deal with that? Get both a Roth and traditional IRA?
That is exactly what you would do. And in the years where you make too much, you contribute to the traditional IRA. In the years where you make enough, you contribute to the Roth. And then you can also, at times, do those conversions if you so desire as time goes on.
Yeah, plus that gives you more flexibility when you do distributions in retirement. Instead of all of your money being taxable when you pull it out, if you have a diversification of Roth and traditional, all of the distributions aren't going to be taxable to you. So that's another way to manage your income in retirement as well.
Excellent. Thank you so much, guys. Now, I don't see another question in here. So I think, here we go. I see that my non-working children do not qualify to participate in either IRA. Will you have a trust cafe coming up, or can I make an appointment with Joanna?
You can make an appointment with me.
Absolutely, and Joanna's information and Chris's information are both on the screen.
Yeah.
If you have any other questions, direct them to me, and then I will basically get the answer for you. That way, if you're not sure who is able to answer the question, just send them to me and I can get the answer for you.
So I saw that there's a Roth one. So remember, teenagers, regardless, you have to have earned income. So in order to have a Roth, in order to contribute to a Roth, you must have earned income. So those teenagers, they need a job, and they also need to be able to report that income. So it can't be just, hi, my kids have a job. Nope. They actually need to file that tax return. They need to be
Chores and allowance don't count.
Oh yeah, exactly right. The allowances do not count.
Yeah.
Grandma money does not count.
Yeah.
Oh,
All right, we have another question coming in. If I'm using my employer-sponsored 401k and maxing out there, can I still open a Roth IRA account and contribute to a Roth IRA?
as long as you meet the income limits, sure can.
Right.
Okay.
Depends on how much money you make.
Yeah.
And also, do you need a tax deduction or do you want the tax free? My personal opinion is when you are, if you are, somebody who's under the age of 40, and if you meet the income limits, put that money in a Roth. That's my own personal opinion. What do you think?
Yeah, I would agree.
Yeah.
Not likely, and obviously we could be wrong. I don't think tax rates are going to go down. So if
So,
you can take that money out in retirement without having to worry about the tax rate, that may be advantageous for you.
right, exactly.
Agreed, agreed. All right, another question. What advice would you give an early career professional as far as what to contribute to a Roth
We
versus
just
traditional?
answered that
Yeah,
question.
that's the
You did?
That's the question we asked.
Oh, I missed that one. I'm sorry.
So if they're dependents and they don't have a job, they can't file taxes. So doesn't matter. They can't contribute to an IRA. That was one of the
Yeah.
questions.
Yep.
That was one of the questions. And then this one was
Can
about
be done.
somebody early in their career.
We
And
answered that one.
then minors filing taxes, question mark, how would I claim them as dependents?
They don't.
Yep.
If you claim them as dependents, they can't file taxes.
That's right. That's why they're dependent.
So they cannot contribute to an IRA.
Yeah.
Right. So I do know, I've worked with our capital management, with our financial advisors, and I do have a retirement account set up for my minor children, or for one of my minor children.
Yeah.
So with them, you can do that. With the credit union, you can't. So I do know that. And then one question is, can I move 401k to a Roth IRA?
You can, but that will be a taxable event. And depending upon how much money is in that 401k plan, it could be a taxable event of biblical proportions.
Yep.
Unless they do a rollover, right?
Nope.
Nope.
It's a taxable event.
Yep.
Really, even if you
Sure.
stop working for that company and you need another vehicle to put the.
You want to put that money, if you don't want to
To
pay
the
taxes, you want
traditional.
to put that money into a traditional IRA.
That's right.
Ah, okay, gotcha. See,
There
I'm
you go.
learning new things every time.
That's what we're here for.
That's it.
Yeah, excellent, excellent. And I hope that all of attendees have learned a lot today too. Let me see if there's any other questions. I think that is all.
Okay.
Somehow they're like coming in out of order, which is very strange. But anyway, so I hope I addressed everyone's questions. If I missed any, please, again, feel free to email me directly and I will get the questions to Joanna and Chris, who will be able to answer them. So now, to the even more fun part of this webinar, now is the raffle question. So I hope you guys took the hints when I added them in chat to pay attention at those particular parts that this question is going to be about. So get your typing fingers ready. The question is, name one of the exceptions, just one, not all four, of the exceptions to early withdrawal penalties. And again, there were four. I'll repeat the question.
Ooh,
Name one of the
They're ready.
exceptions to early withdrawal penalties. And the questions will have to be answered in the chat.
they're on it.
Yeah. Yeah, they are.
Yeah, holy cow. They're rolling in. And all of them are correct. So the first one that I see was Shoban.
Yeah,
Is that what you guys see too?
that's what I see.
All right. Excellent. So Shoban, I have your contact information from your registration. I will email you and ask you for your mailing address so that I can send that $25 Visa gift card to you with some other goodies. I always put a little more in there just for fun. So anyways, you guys, thank you so much to our panelists, Chris and Joanna. Amazing job as always. Congratulations to our awesome raffle winner, and thank you for answering the questions correctly and for paying attention. Very important, and I hope again that all of you learned something new. I know I did, so great job, you guys. Until next time, so we are actually having the more in-depth conversation about IRAs in 2 weeks from now, where you will learn a little bit more information, and that is on the 27th. And an email will go out about that one as well. So I hope that some of you will register for that. And at that point in time, Chris and Joanna will join us again, and I will be here as well. And this recording, like I said in the beginning, once I get the link to our YouTube channel, I will send that out to all the registrants, and watch it at your own leisure. And again, if you have any questions, please let us know. Thank you guys so much. Chris and Joanna, did you have anything else that you wanted to mention?
No, just thank you for your time.
Thank you.
Absolutely.
Bye-bye.
Okay,
Have a
bye,
good day.
everyone.
Bye.
Bye.